Well, good morning from Basel. My name is Hyun-Sung Shin, and I'm the economic advisor here at the BIS. And it's really my pleasure to moderate this panel on payments in the post-COVID world. And indeed, I suspect the future of payments more generally. The BIS is part of the official sector, but there's been I think, a well-recognized division of roles between the official sector and the private sector, with the private sector using its ingenuity and creativity to serve customers better, and the official sector is there in the background, ensuring the integrity of the monetary system and the finality of settlement and so on, and more lately issues such as a competitive level playing field and data governance has also come up. But I think the panel today, we really have the best panel we can imagine to discuss the future of payments, very much from the customer-facing side, and we have some of the leaders in the industry today. So let me give a brief introduction to the panelists, and then we'll have a round of introductory remarks, and then we will transition to the panel where we can have a more interactive discussion. So let me introduce the speakers very briefly in the order that you see them on the screen. First of all, we have Piyush Gupta, who is the CEO and director of DBS Group. And DBS is well known as a leader in financial innovation. It has a very strong presence in the banking sector, but has been an industry leader in innovation. And Piyush himself, as many of you know, is really a very well-known leader in this field. Next, we have Dilip Asber, who is the CEO of the National Payments Corporation of India, NPCI. And he's played a pivotal role in some of the really important infrastructure developments, in particular the UPI fast payment system, which has served as a model for fast payment systems that other countries have really looked at in order to emulate. And we're very much looking forward to hearing from Dilip on issues such as data governance and the use of APIs for ensuring a competitive level playing field and so on. We have Diana Avila from Wise, formerly TransferWise. They have recently rebranded. Wise started off, as you know, as primarily a remittance service, but it now has developed into a much more substantial presence, offering multi-currency accounts in several economies. And we're very much looking forward to hearing from Diana on especially the cross-border elements. And last but not least, we have Ruben Lai, who is the Senior Managing Director and co-head of Grab Financial Group. And Grab Financial Group spans payments, lending, insurance, and wealth management. And it's part of it's a subsidiary of Grab, which is the well-known tech group in Southeast Asia, known for ride-hailing and delivery. But it's now a very important presence in the sector, which connects millions of users with merchants and businesses. And we're very much looking forward to a very active discussion. And thank you for joining us today. So Piyush, if I may turn to you first. I think what we've seen with the pandemic is a very rapid drop-off in the use of cash. What do you see, and what kinds of issues do you think will arise as the use of cash becomes less and less important?
Well, first of all, Hyun, thanks for having me on this panel. It's a pleasure to be here at this BIS Innovation Summit, and especially with such a great bunch of fellow panelists, companies who I admire a lot. So on your specific question, it's true that cash has fallen off sharply in the course of the last year. But let me first say that I would suggest that a large part of it is just because people have not been able to get out on the streets and be up and about. And therefore, while I do think that there will be a sharp change in the use of cash, I also think that there will be a rebound of some sorts. I don't think cash will be as low as it was through 2020. I think use of cash will bounce back. The best example you see of that is demonetization in India. In the year of demonetization, all of the large value currency notes were eliminated, and so everybody didn't have a choice. They all moved to alternative payment types, the Paytms of the world. But if you look at the cash statistics for the next year and the year after that, actually cash usage came back up. Not all the way up, but relatively came back up. So the underlying point to consider is cash is sticky. We've tried to get rid of cash for a long, long period of time, but it has not happened very easily. Plastics, Diners card came into being around 1950. So plastics have been around for 70 years. But if you look at the relative share of debit and credit plastic in most economies relative to cash, it is very small. And obviously, using the mobile phone to make payments, both domestic and cross-border, those capabilities have existed in fair measure. But other than in special situations, in China, obviously with Alipay and WeChat, and Kenya through M-Pesa, etc. By and large, cash has continued to be quite dominant. So the point I want to make is cash is sticky and not easy to get rid of. Now, obviously, you want to get rid of cash. It's expensive. It's about almost 2 percentage points of GDP. The printing, the storing, the mint, the transport. So it's not the most efficient means of payment. It's also subject to a whole load of misuse, the anti-money laundering and illicit use of cash. So there are good reasons to want to get rid of cash. But then you got to wonder, if there are good reasons to get rid of cash, why does it not disappear? Why is it sticky? And you boil down to a few things which are important to consider. I call these 3 A's of cash. Number one is availability. Cash is ubiquitous. Anybody has access to cash. You frankly don't even need a bank account. When you exchange a good or service, people pay you in cash. You use the cash, you can pass it on to other people. So that availability is important, because when you compare it with the alternatives, you either need access to plastic, you need to go to a bank, you need to have a mobile phone, you need to have some sort of device which makes it a little less available than the freedom to have cash. The second A I call acceptability. Everybody accepts cash. Whereas, again, if you have a different form of payment, you need to have an acceptance infrastructure. You've got to have a merchant acquirer. You need to make sure that there is a scheme and infrastructure for switching and sharing. And all of those things, if they don't exist, don't make it easy to pass the acceptability test. And the third, frankly, is anonymity. A lot of people just prefer using cash because that doesn't leave a digital footprint. Nobody knows exactly what you're spending on. And it's not just the crooks or the bad guys who value that. I was having a conversation with a very senior banker in Switzerland, actually, one of the chairmen of the local Swiss banks. And he told me he was dead against moving digital because he wants to retain the privacy and anonymity of people not knowing what he's spending money on. So there is this natural thing about privacy which cash provides. Now, these are not easy advantages of cash to eliminate. Nevertheless, it can be done, as we've seen in place after place, that where the infrastructure is put into place, where the customer experience is focused on, then you do start getting a shift in people and consumer behavior. I think the things to watch out for if you really want to accelerate the shift, you've got to think about inclusion. You have to make sure that everybody has access to a new form of payment. You have to think about, in that context, the digital divide. It should not be that people who have access to technology or access to digitization benefit and others can't achieve payment means. You have to think about data privacy. I think it's important because at the margin, there are a lot of people who would love to have access to every form of payment data, but is that truly wise? So you have to think about some of these artifacts. And obviously, most of all, you got to think about infrastructures and the nature of those infrastructures. Should they be private? Should they be public? So if you put in place all of these safeguards and you put in place the infrastructures, I do think you'll see a migration. And so to end on a glass half full note, I think a large part of the migration that you saw last year, where I started by saying not all of it will stick, but the glass half full note is a substantial amount of it will stick.
Well, thank you, Piyush, for that. Let me now turn to Dilip. Let's see if we can have. Great. Well, Dilip, it's really a pleasure to have you on the panel because you bring a lot of very keen insights into fast payment systems. I think the term fast payment system probably doesn't do justice to the other features of UPI, which is the retail payment system in India that you were responsible for bringing in. I think it served in many ways as a model for fast payment systems really anywhere. And there's the issue of digital identity with the Aadhaar system being the kind of the foundation for that, and then there's data governance, but also a competitive level playing field. So Dilip, I think we would be very interested to hear your views on the role of technology in ensuring these very desirable features, but also in the context of the G20 cross-border payments initiative, what you see as being the key developments we can expect in connecting fast payment systems, across borders.
So thank you, and thanks for having me here. And when we look at and some of the things which Piyush was talking about, the cash, and I was actually trying to correlate how core these issues were being part of the design principle of UPI. When we spoke about the speed or access or simplicity to use, the instant gratification or the finality to the transaction, so all these things what Piyush was talking about were actually the time 4 years back or 5 years back we were discussing amongst ourselves within the NPCI employees when we were looking at designing the UPI. So when we looked at UPI and when we looked at the general customer awareness, we thought that the simplicity has to be a key aspect, whether it's onboarding or whether it's using UPI. The second thing we looked at is the speed of the transaction. The speed of the transaction has to be really fast. And now that when we looked at demonetization, as you spoke about, the UPI has really scaled up till then, and we saw it further during the pandemic, where the merchants and customers were willingly moving towards the digital payment options. Obviously, as you said in the beginning, the developed countries have started seeing the reduction in cash. I think that is a stage where India still has to reach to. However, thanks to the innovative policies of the Reserve Bank of India and the government involvement and the key focus on the digitalization of the payments, we have actually laid down the solid foundation for the reduction in cash in the future, right? And now we are looking at 200 million Indians are actively using the digital payments as a regular course of actions. We believe that another 200 million users adding up in the digital payments game, we will start seeing the reduction in the cash in circulation. Obviously, we are also looking at various other use cases, and we'll speak about it. We have recently formed NPCI International to predominantly talk about to look after whether there is a possibility to connect to cross-border real-time payment systems, and we have been working very actively with FAST on this. Whether the connectivity between the FAST and UPI in India, can we look at a real-time account-to-account remittance, cross-border remittance? We are working on that. We are also trying to look at the mobility as a sector, right? Because that's again a big driver of the cash consumption. Whether it's a vehicle, whether it's the transit. So we have big plans, and I see a great future for digital payments in India in the next few years.
Great. Thank you, Dilip. Let's keep on the cross-border theme. As you know, one of the key themes on the G20 agenda is cross-border payments, and in particular, raising the efficiency and lowering the cost of cross-border payments. Diana, could I ask you to share your experiences with us on what you've seen from the industry side, how the incumbents and new entrants have interacted?
Thank you so much, and thank you for inviting me and having me in this panel today. The topic of cross-border payments in Wise, we've been focusing on solving this problem for the past 10 years. And one thing is clear, and is the fact that the old way, correspondent banking, is not fit for purpose anymore. Customers are looking for better ways, and they have high expectations when it comes to move their money, not only domestically, but also across borders. We have identified 4 key pillars, which are the 4 pillars of Wise in terms of cross-border payments. And this is what innovation and competition has been able to deliver to the market. These 4 pillars are the following. The first one is customers expect to move their money across borders instantly. There's no point on having to wait for hours or days to receive a payment. Similarly to how money is moving domestically, and we just heard in an instant manner, and even more during the pandemic, when people are sending money to their families abroad, or when there are e-commerce transactions across borders, both parties want the transaction to be completed instantly. The second pillar that we have identified is transparency. It's very important for customers to know exactly how much they are paying when transferring money internationally. And we have seen this from the G20 and also from the World Bank, with the goal of reducing the cost of remittances below 3%. There is no way for customers to know exactly how much they pay if they have to be comparing pears and apples when it comes to the cost that is being disclosed by the service provider. There are service providers that disclose as 0 fee the international money transfer, but then when it comes to the FX margin, they are overpaying. They are paying way more than this 3% goal. So it's very important to boost and to have the requirement for service providers to openly and transparently disclose the fees that they are charging. The third pillar that we see is convenience. Customers, similarly to how they do domestically, they are now able to pay with QR codes. They are able to pay with the mobile. Is exactly the same for cross borders. And even now with the pandemic, more than ever, people are turning to digital solutions. They are not expecting to go to a bank branch anymore or take cash and move money internationally. And the fourth pillar is low cost. I've been referring to this one as well. And there is no point for people overpaying when sending money internationally. We know that, for example, in 2019, individuals paid over $49 billion when sending money for remittances. This is $49 billion that ended up with financial institutions as opposed to supporting families in the countries where they were needed. So all these are the different pillars that we are pushing, and there's more competition coming. And the great thing about competition is customers get to choose the best alternative.
Thank you very much, Diana. Let's now move to Ruben and discuss embedded finance. Ruben, embedded finance refers to this very fast-growing trend where financial services are integrated into the platforms that people use on a daily basis. Share with us your experience on embedded finance.
Sure. Thanks a lot, Hyun, for having me here today, and really glad to be alongside such an esteemed set of panelists. Maybe for me to answer that question, let me just point us back to the origins of Grab Financial. So we started about 3 years ago, and the whole thesis behind that was really how do we equip our customers, and customers meaning both on the seller side of the ecosystem and as well as the buyer side of the ecosystem, with payment methods that allows us to grow our ambitions as a super app. So we needed a way to allow the sellers to collect money, and we needed a way to allow our buyers to transact across multiple services very seamlessly. So we started the journey with GrabPay, and then over time, we slowly launched lending, wealth, and insurance. And of course, last year, we were very blessed to get the digital bank license in Singapore. But underlying all of that are three principles that we design all our services. first is accessibility, so micro everything. And then the second is really about convenience. And this is your point about embedded finance. So what we believe is microtransactions embedded into the daily flow of a consumer or a seller would result in more convenience for our customers and greater satisfaction. And then the final point is around transparency. Very, very clear how much we are charging our customers so that they don't get caught unawares. And what we've seen using these three philosophies in the various products that we've rolled out are high conversions and tremendous customer satisfaction. One such example is on insurance. So in Singapore, for every ride, a customer is able to select whether they want to be covered by insurance, and that is fractionalized. So it's a very low cost, 50 cents premium per ride. And what we've seen is that a large proportion of our customers are actually opting in and choosing to remain on this insurance coverage because it's relevant to them. They want to seek protection during this time, and it's so convenient. It's just an on and off button. These are examples that when financial services are just embedded into the everyday flow of a customer, the conversion rates are tremendous, and our customers are very, very happy.
Great. Thank you, Ruben, and thank you all for those introductory remarks. So, Ruben, perhaps I can follow up on customer behavior, and perhaps we could also bring Piyush into this question as well. It's traditionally hard to get consumers to change old habits. Are you seeing that change? And how much of that has to do with improving the customer user experience? So let me turn to you first, Ruben, and then Piyush.
Sure. So what we've really experienced last year is a great acceleration. I think the circumstances, resulted in customers really converting to digital services in order for them to cope with lockdowns and the pandemic. And we've seen customers after switching that they actually have remained cashless. And not only that, we've seen them taking up various other financial services. Insurance was the example I gave, but we've also seen the same for wealth and lending as well. And I think it's driven, one, most certainly by the macro environment, and then the other is also we've partnered governments on this journey as well. So in Malaysia, for example, knowing that they needed to get the citizens to use and embrace digital payments, they actually worked with 3 digital wallets. We are one of them, and we are the only private sector wallet to partner them in dispersing to the population. There are 2 objectives there. One is, of course, to support micro merchants, and the second is to educate and encourage the citizens to embrace digital payments to transact online. And the conversions there were very high. We've seen even the net new customers that came on board post the stimulus money being consumed, they still remain on our system, and they transacted more than before. In terms of the aid going to the merchants, the government was very focused on making sure that it went to local merchants and as little leakage as possible. And because it was all done digitally, we were able to trace all the flows, and actually the vast majority of them went to supporting the local merchants.
Thank you, Ruben. Piyush?
So let me, first of all, I think catalysts which force people to convert help. I talked about demonetization in India 3-4 years ago. That helped. I think the pandemic helped, without a doubt. As people got to more and more digital consumption, you don't have a choice. You can't pay in cash by and large. So you want to pay on the site, on the e-commerce platform. So you need to change your payment form. So catalysts help. But as I also said before, catalysts are not enough. You need to be able to ensure stickiness in the new payment type. And I think for those, the kinds of things that Diana and Ruben talked about are of paramount importance. So the customer experience, the user experience is important. That includes design, that includes form factor, that includes do you have to make 3 clicks to pay or 1 click to pay, etc., etc. I think the embedded nature of the payment makes a big difference. You want to be where the customer is. You want to be where the customer needs to do the payment or the transaction, as opposed to have the customer shift and move to your environment. You need to be in the customer's environment. So the minute you get more embedded finance, more embedded payments in the ecosystem where the customer, you get a much better conversion rate and much better pickup. I think loyalty schemes help. So if you look at, one of the downsides of cash is you can't create loyalty programs. But if you look at the big take-up for, Ali and WeChat in China, a large part of that was driven by loyalty, both at the merchant side as well as the consumer side. You create incentive systems to create behavior, and then the behavior over time becomes a pattern. So that's the third thing that you can do, and it helps. But overall, I mean, the underlying this thing has got to be convenient. It's got to be frictionless. It's got to be in the customer's domain. It's got to be contextual. It's got to be at the right time. These things all matter. And if you can get that to work, you will get conversion. The other piece which I mentioned in my opening comments, acceptance must be there. So, if you don't have acceptance on the other side, you don't have enough places to use that payment type in, then of course you'll fail again. So that speaks to the infrastructure, the instant infrastructure availability that needs to exist as a precondition.
Great, thank you, Piyush. I have a follow-up question for you, actually, which is, in your, from your perspective, first of all, from the formal banking sector, but at the cutting edge of innovation, perhaps we could turn to the role of non-banks in the payment world, and perhaps we can also bring Diana into this conversation as well. I mean, from the point of view of the consumer, Piyush, as you said, what they see is the very responsive, apps they see on the phone. How do you see that distinction between the formal banking sector, which is, after all, the sort of mainstay of the payment system, but then this additional element of the non-bank payment services providers coming in?
So I think first of all, I think in terms of getting the right customer experience and innovating, this is not the domain or the purview of any one player. I mean, technology is available to everybody. It's all open source today. And so a capacity to put together the right solution set is frankly, or like I said, anybody can do it. You can be a bank, you can be a non-bank, you can do it at scale. Sometimes what you need to do is make sure you have the right customer obsession and you have the right culture to be innovative and nimble. And those are things oftentimes that incumbent banks suffer from because they have legacy systems. They don't have the capacity to use a modern technology stack. They just don't have the culture to be able to adapt. If you build those things, then frankly, there's no reason why you're any different from any other non-bank tech company. They're two different, where they're different. Banks are advantaged to the extent that people build full-fledged financial relationships with banks. So you have your financial health, you have the entire suite of products. Many of the techs, like Ruben said, are trying to build those products. Banks have them. Banks are also further protected by regulatory framework, deposit protection. So the whole element of inertia and trust, banks benefit from that. A lot of the tech companies benefit from existing ecosystems. So Grab benefits because they have a ride-hailing system, they have a food delivery system. So they have an existing ecosystem of customers that they can embed their products in. In the case of banks, you've got to build those ecosystems. So you have pluses and minuses. You have different kinds of pros and cons. But fundamentally, to me, the opportunity to improve the customer experience and do the right thing for the customer is equally available to incumbent banks as it is to technology companies, depending on what you're trying to do. By the way, on the cross-border domain, again, there's no reason why banks can't do exactly what Diana said Wise is doing, because fundamentally, this is what we do. We have a similar product limit, and we do that in the same way. You eliminate the correspondent banking network and try and drive low cost. As we go forward, actually, the banking system will also leverage what Dilip talked about, which is direct access into the payment systems cross-border. We're doing that. In fact, Singapore couldn't announce something with Thailand or get it ready by April. Thailand's got a system called Prompt Pay, which accesses the domestic payment rails. And we're linking up Pay Now in Singapore with Prompt Pay. So you can, the banking system cross-border, just instant money transfer, account access cross-border. And as Dilip said, we're exploring and doing that with India, between the FAST system in Singapore and the UPI in India. So when you do that, you actually get around all of the existing correspondent banking networks. Then you have instant payment by accessing account-based direct access across borders. So I think you'll start seeing a lot more of that as well.
Great, thank you, Piyush. So Diana, perhaps I can turn to you. What has been your experience when you're when you're dealing with central banks and access to settlement accounts and so on?
Thank you so much. For us, it's really important that we have seen the benefits of, as a payment company, as a non-bank regulated financial institution, being able to access settlement accounts with central banks and access directly payment systems. So we have done this in a few jurisdictions already. Where we first did it was in the UK, when in 2018 we were the first non-bank institution to get a settlement account with the Bank of England. And this has enabled us to complete payments faster for our customers, the ones that are initiated from the UK, and payouts, international payments coming to be paid here in the UK. We went from 0% of these payments being instant to 60% of these payments nowadays being instant. We also went and were able to drop prices. So after connecting directly to the payment system, we were able to drop the prices by 20% to our customers. So our experience is, we believe that regulators, we believe that central banks should create the alternative for payment companies, for non-bank regulated financial institutions, to be able to connect directly to the payment systems. As we know, banks traditionally have been the ones connecting to the payment rails, but what customers are seeing is they have a need for payment services that goes beyond what the bank is offering. Banks are doing great things, and they have been around for many years, and they provide domestic service to customers. But not all the time what the customer needs is exclusively going to be provided by the bank. And that is why it's so important for payment companies to also have access to these payment rails, to rails that enable money to be moved, transactions to be completed, and it doesn't necessarily require what the banks are offering, which is receiving payments from customers and lending those funds out. There's way more needs and way more payment services that customers are asking for. And to complement also this topic about banks and what Piyush was saying about the importance of having the service where the customer is already, there's no point on necessarily expecting customers to switch to new ecosystems. One thing that we have also been doing is partnering with banks, enabling our service and enabling our ecosystem and our connection to be used by banks and other partners, of course. In this way, the customer is already in certain ecosystem. They already have their bank app, because it's not only payment institutions. Banks, of course, are also focusing on digitalizing and improving their digital service and their innovation. So a good way is also when the banks and traditional companies and other financial partners are able to partner with companies like Wise, use the infrastructure that we have developing, and in this way provide a service for customers that is much better when they want to conduct cross-border transactions.
Actually, if I can come in. So,
Yes.
I think having access to the payment systems from everybody is actually not a bad idea, but it needs to be governed and needs to be thoughtful. I think MAS in Singapore has been quite thoughtful about the framework is put in place. And there are two things to be concerned about. One is obviously financial system stability. It's something which is important to the financial sector, to the official sector. But the reality is, when you have billions of dollars floating around in these systems, then the need for supervision and to have capital and liquidity provisions becomes quite important. Wirecard is a great example. So things can go wrong, and if you're not adequately governed and supervised, you do create potential for systemic instability and something to worry about. I think the second thing to worry about is obviously level playing field considerations. Because you take, the Chinese have issued this consultation paper recently, which I think is quite spot on. Because for years, the non-banks in China just benefited from regulatory arbitrage. They didn't have capital requirements, they didn't have liquidity requirements, they didn't have supervision requirements. And so it's very easy to compete when you're given a pass. You don't have to take on the social load of having a cash system and a network and look after, inclusion issues and the bottom of the pyramid. So I think in the interest of level playing field, I maintained all along, it is important to make sure that everybody is facing a common set of rules and a common set of approaches so everybody can compete equally.
Absolutely. If I may quickly
Yes,
compliment
Diana, go ahead.
there. Absolutely agree with that, and that is what we have been seeing. When you mentioned about MAS, we also only a couple of weeks ago announced our connection to FAST in Singapore, and definitely it has in the background a new supervision for WISE. We are licensed in the countries where we operate, and we know that for us to access the payment system requires certain level of supervision, liquidity requirements, capital requirements, which we comply. And at the end, is very important that we preserve the safety net of the payment rails. Agree with you. The more participants we have, the equal the rules have to be, and the controls for payments to flow freely and to flow safely through these rails, for sure.
Well, thank you, Diana and Piyush. I think this is a very, very interesting discussion and a very important one. I think the access to the central bank's settlement accounts to non-bank payment services providers has been a really active policy topic for debate. And I think we've explored some of the key issues here. One is the financial stability angle. The other one is the regulation angle. Perhaps I can turn to you, Dilip, and continue this discussion. I think the UPI system has been really a model for how you can ensure access through APIs and a competitive level playing field. What do you see as the future of the non-bank sector in the payment system?
If you look at the UPI architecture, we were very clear right from the beginning that the banks and non-banks will collaborate with each other to access UPI. And when we looked at banks, the bank brings in the stability, brings in the security, trust of the common man, and they would like to park their funds with the banks, and the banks are the best when it comes to the money management, the reconciliation, and the customer service. When you look at the fintechs brings out the best of the tech, the superior user interface, UI, UX. I think the UPI married both together, and UPI kind of forced the banks and non-banks to collaborate. When we looked at, and we were very mindful about some of the risks which Piyush spoke about, so we kept the authentication activities completely into the bank's domain, right? And tried to give a very superior win-win kind of a model back to the consumer, where he relies back the superior UI UX offered by the tech, by the fintech, and the looked at operating his bank account, being at the bank, and take the best of both the worlds. Obviously, there are a lot of risk, and we have been working very closely with the regulator in terms of having the security, having the compliances in place, just to ensure that all the parties, whether it's the banks and non-banks, come back to the common rule set as far as the obligation to the central clearing house is concerned.
Great, thank you, Ruben. Sorry, Dilip. Ruben, perhaps we can turn to you. We talked about embedded finance and the convenience of being able to embed financial services in the platforms that consumers use on a daily basis. I mean, we've touched on issues to do with data and the combination of different services. I think one issue that Piyush mentioned is this link between, for banks, they're also lenders as well as payment service providers. And in terms of credit, I mean, this pay now, buy now, pay later kind of function that's embedded in many of the apps. I mean, how important do you think that credit function is as part of embedded finance?
Yeah, thanks for the question. And first, I did want to say, everyone, whenever around the world we talk about faster payments, they always refer to what you've done at UPI. It's such a gold standard. There's the reference for all countries. And we're very blessed out here that regulators that rolled out Fast in Singapore, PromptPay in Thailand, InstaPay in Philippines, and Linkaja in Indonesia, they are all building out similar type of networks. And I'm in total agreement with Piyush that having a regulated RTGS system that is stable is good for society, is good for the economy, and we're very blessed to have regulators that are so forward-looking that would invite banks and non-banks to collaborate on it. So that's a really, really good development. In terms of buy now pay later, yes, it's flavor of the month, and you can't go from 1 week to another without seeing a whole flurry of articles around it. In our view, it is an innovation that's good for the customer. That's the lens that we try to take. In our part of the world, at least, most of our customers do not have access to credit cards. And at least for the customers that we see on our platform, our drivers, our delivery partners, and many of our merchants, they didn't have access to credit. And for them, when they needed cash, when they needed money in situations where they had to meet payments, could be a health situation, could be a business situation, they had to turn to friends, family, and some even in the informal lending market. For us, how do we address that segment of customers? It could be through lending, it could be through payment products like buy now, pay later, which transfers the part of that risk, the payment for risk, to the merchants. And the merchants are happy to contribute to that because they see an increase in conversions and demand for their products and services. That's the way that we look at it. Of course, with all products, payments products or lending products, there's always risk when taken and abused. And I think that's where, as an industry, we need to educate people and inform them of such products and such risk, so that people spend within their means. Look, even with a debit card, they easily spend beyond their means, and so it's not about credit or debt. It's really about education for the customers.
I guess one of the issues with the buy now pay later. I agree with that. I think it's a good product, and if you don't have a credit card, it's a good way to get credit. I think from a supervisory and a central banking standpoint, when you approach this thing through a credit card regime, the central bank has easier mechanisms to apply macroprudential controls. So they put down controls like 4 times unsecured income is the maximum, or 12 times is the maximum you can take in the system. And in countries where the central bank is actually quite proactive macroprudential controls, like in Singapore, they keep a tight lid on consumer credit by doing that. The minute you democratize it, and so every merchant and every seller is making the decision on whether to give credit or not, it becomes much harder for the central bank to exercise that degree of control. Now, this is a philosophy thing. Should the central bank actually be involved in the underlying thing of creating consumer credit or regulating or consumer credit or not? If you believe it's the function of the central bank to make that, then it becomes harder with a buy now, pay later kind of situation. If you believe it's the market should determine it, then obviously it doesn't matter.
Right. Thank you, Piyush. So we only have a few minutes left. I mean, it's been a very rich discussion. I wish we could carry on, but I think we're going to have to wrap up. Let me perhaps offer a few perspectives from the official sector, and I think it chimes in very much with what all of you have said. Traditionally, we've very much had this back office function. We are there to ensure the integrity of the monetary system, finality of settlement, and so on. But I think, as technology has progressed and we see financial services become much more democratized with innovation and in the various services, especially cross-border, I think, our task has also, grown with that. And perhaps two elements that have really come in here are data governance, especially with digital ID. How do we govern that framework, and also the issue of competition that also Piyush mentioned, especially with the big techs that have become much more important with a much bigger footprint in the financial system. I think the traditional thinking along the lines of competition versus financial stability, that's now developed much more into a much more multi-dimensional discussion about competition and data privacy as well. And I think we really have our homework to do. And I think we have heard a lot from this panel that will be food for thought for the BIS and the official sector more generally. So let me thank you all for giving us your time to give us your insights and making this event such a lively and active discussion. So thank you very much. I think our session will be one of the highlights of the BIS Innovation Summit. There'll be many lessons to learn, I think, for both official sector and private sector participants, across the world. And it's interesting that the participants on this panel are drawn from Asia. I think that's a very, very interesting observation on where the innovation is taking place. So thank you again. Thank you for taking part.
Pleasure. Thank you. Thanks everybody. Pleasure.
Thank you.
Good discussion.